Hey, it's Soleil, and this is episode 79 of the Orange Pill Investor. And today I want to talk about why. So, why trade? Why Bitcoin? Why sell options? What are the trade offs? Why MicroStrategy? Why mining stocks? Why do I sell 1 week calls, 1 week days to expiration? And why do I pick the strike that I do? And so I thought it would be a good chance to take a look at this and try to answer these things from first principles because you have to have an assumption in order to have a strategy. So the first question, why trade? My base assumption is that stocks usually go up. If sometimes they come down and come down hard. However, just looking at the stock market over time, reasonably trends in the upward direction, and that should happen for good companies under most circumstances, but as long as the US government and almost every other government on the planet continue to print money, I think it's reasonably safe to assume that we can count on inflation for as long as they continue to do that, which will probably be for forever or as long as they exist. And the S&P 500 I think goes up like average 7% a year, but I think there's which basically paces inflation. Some people may want to argue about CPI or whatever, but CPI is not inflation, and I even think that the 7% inflation rate hides some hidden inflation because technology is naturally deflationary. So I think things should probably be getting about 3% cheaper every year if the government wasn't printing money. So really we should be able to enjoy more and more things every year with our money instead of less. But since our grandparents have been around, you've probably been able to just put money into stocks, pace inflation, and buy a house, and you're good to go. So, but that's my basic assumption is that the stock market generally goes up, so I generally trade long. Now I do limit my upside, and I'll get to that later. So my second question is, why do I trade Bitcoin or store it? Actually, use it as my store of value. I no longer actively trade it. I used to trade all manner of shit coins along with Bitcoin, and I would trade in and out of Ethereum if the ratio looked like you could get more Ethereum with your Bitcoin. But if you take a look at that chart, it's a freaking disaster. So I'm a reformed, degenerate shitcoin trader. But the reason I continue to own Bitcoin is it's the hardest money ever discovered. And I say discovered rather than created because although it was created, I would say that most money is created. I mean, even gold is kind of like discovered in the earth, but then to melt it down and form coins, you kind of create it as well. And if you look at the history of money, every culture discovers the money that they end up using. So some cultures used glass beads, some used gold, some used silver, some had like giant stones that you couldn't even carry, and you'd just have like this 500-pound stone in your front yard, and if you quote unquote sold that to somebody else, you'd just go like out into the town square and yell to everyone that can hear it that you traded your money to somebody else and they're the new owner of the stone. So everybody discovers what money works the best, and money always value always flows from soft money to hard money. So that's why glass beads, nobody uses glass beads anymore because they can just be manufactured. Gold was the best money for the last 5,000 years. It can't be created, but we're constantly mining it, and we're figuring out new ways to mine it. And every year we're increasing the supply by a couple percent. So there's inflation built into gold as well. However, inflation is not possible with Bitcoin. So it should continue to go up forever in relation to all other forms of money that are softer and weaker. So why sell options? I sell options against my shares for a greater chance of success, which is achieved by reducing my cost basis. So if I pay $10 a share and I sell a covered call at the 10.50 strike or the 11 strike, and I get paid $50, then that reduces my cost basis by $50, and instead of paying $1,000 for my 100 shares, I only paid $950. So I'm giving myself a discount every time, and of course there's a trade-off, and people will accuse me of picking up pennies in front of a steamroller, because by selling that covered call at 10.5, I'm limiting my upside to $10.50. And if it were to shoot up to $20 a share, I'd get the $50 from 10 to 10.50 plus the 50 that I got paid, and then the other guy would get the $2,000 minus the $1,000 that he had to pay me, 10.50 for my shares, so he'd make like 800. And that's the main criticism. But my immediate counter to that is, how often do you geniuses actually need unlimited upside? I mean, maybe if you're invested in some kind of pharmacy stock that gets approved and you happen to be holding it and it goes up times 10 or 20 or 100 or whatever. But that I wouldn't sell covered calls on those anyway, because that doesn't make sense to me. So that's why I trade. That's why I sell options. Is I want to reduce my cost basis every chance I get, and what that also allows me to do is take that premium that I got paid and buy more shares with it. I don't have to add any money from my checking account. I can just buy more shares, and so I'm actually creating money with my money. And eventually, when you can sell enough covered calls to where you're making enough on the premium to buy another 100 shares, then you can actually sell another covered call every week than you did the week before. And your returns, instead of like 1% a week, turn into 1% times 1%. And that ends up being, instead of 52% annual returns, turns into a 67% annual return. And that's assuming that the price of your stock doesn't move at all. It can just trade sideways. You'll still make those kind of returns. Whereas the buy and hold crowd will have earned nothing. They'll just have what they had when they started. So that's why I sell options. And then why do I trade MicroStrategy? So MicroStrategy is a leveraged Bitcoin play, really. And they are currently conducting what's being called a speculative attack, and kind of on the US dollar, but basically on money printing. So when you're an institution like they are, they actually can borrow money from the banks, and when they do that, it's not like they just hand over a mountain of cash. They just press a button in the computer, and it creates money out of thin air. So the dollar is already weak compared to Bitcoin, as I discussed with the why Bitcoin section. But so they take weak dollars, they buy hard, good money with it, called Bitcoin, and then by borrowing it in the first place, that creates more money out of thin air, which makes the dollar weaker. So then they can just pay the loan back with weaker dollars. And then as Bitcoin appreciates, they can just, if they had to pay off their debts, they could sell a little bit of Bitcoin after it's gone up 2, 3, 10x, and convert that to the weak dollars, and then pay off the loan with that, with basically pay off with dollars, like basically monopoly money at that point. So at least during this bull run, and my basic assumption is that this bull cycle will mirror the previous one, and it may not, because Bitcoin's getting less and less volatile all the time. So maybe these cycles will just spread out, and we won't really have a big bull and a big bear cycle. Maybe it'll just kind of smooth out. But I'm assuming at least another cycle or two. So I'm trading, basically long MicroStrategy until at least the end of 2025 and possibly forever. Why do I trade mining stocks? So MicroStrategy is pretty friggin' expensive. You can only, unless you're Michael Saylor or I don't know, Zuckerberg or Musk or whatever, you can only afford a certain amount of it. So, kind of with the leftovers and whatnot, I will take some of the premium that I earn with MicroStrategy and purchase 100 shares of whatever mining stock, and let the value of the account go up, almost kind of like compound interest. All the mining stocks generally tend to benefit from Bitcoin. They can have little pumps and crashes based on their earnings reports and whatnot. But in general, as Bitcoin pumps, they all pump. So I'm also long on mining stocks until end of 2025. Mara, Riot, CLSK, Hut. I don't think I missed any. Those are the four that I trade. There's a bunch of other ones, but I try not to trade anything too far under $10 a share because it's too hard to get premium. And even when you can get 20 or 30 bucks, it's going to cost you, a buck or maybe $5 in between the bid-ask spread just to get into the trade, and maybe another, hopefully less than $5 to get out of the trade, depending on the liquidity. So, trying to get premium on things under 10 bucks can be a little dicey. Why do I sell weeklies instead of longer durations? And the reason is because, and let me just pull up Mara. I like that this is the weekend, so I'm getting a full trading week. But let's say I was going to sell an at-the-money covered call on Mara at the 22.50. So you can get $1.50, which is that's insane. 1% would be 22 cents, so that's 5, 6, 7, like 7% at the money. No real call away value there, but that's not the point of this example. Just have to remember that. $1.50 at the money for the week. If this was going to double for 2 weeks, this should be $3, but it's not. So you get $1.50 for week 1, and you only get 70 cents, 70 bucks times for week 2. So this is 220. Every week this is going to get smaller and smaller. So from 220 to 267 is only 47 cents. So if I was to go out a month, I can get 320. It's like, oh wow, that's amazing premium, and it's pretty good. But divide this by 4, that would be 80 bucks a week. Whereas if I just go 1 week, I can get double 80 bucks, and then next week I can get another $1.50, and then next week I get another $1.50, and next week I get another $1.50, and I get over 4 weeks I get $600 instead of, what was it? Yeah, basically double. I can get $150 a week, which is $600 for 4 weeks, instead of $320 for 4 weeks. Now, granted, Tasty Trade has some research out that says I can't go to 45 days to expiration because that would be like on a Wednesday. But their research shows that if you go out here to right around 80%-ish, probably a 0.3 delta, that's a 0.4 middle. Anyway, somewhere around here, if you go out to 45 days, then you can collect half of this in 2 weeks, 2 to 3 weeks, which would be, still that's only $1.30 in 2 weeks. That's only $65 a week, whereas selling the weeklies at the, wherever, is collecting $150 a week. I generally don't do at the money though. That was just an example to illustrate how extending weeks decreases your premium. But I always try to bake in, well, you can see that I did the 24.50. So I'm trying to bake in 10% call away value plus the 80 bucks, which is 4%. So 4% call away plus 10%, 10% call away plus the 4% premium. Technically, if this trade went to 24.50, I would get the 10 and the 4. and make 14% this week. So that's why I laugh in the face of people who talk about picking up pennies in front of steamrollers, because if somebody said they were going to make 14% every week, that's not realistic. You know, sometimes this trades down and you actually, you know, your account goes down, just like anybody who buys and holds. But the potential, the guaranteed profits is the 4%, and then the potential profit is the 14. And to me, that just destroys most of these other strategies: the buy and holds, the dividends, the index funds people, the real estate people. Selling the weeklies, to me, just knocks them all out of the park. I saw some guy who was doing day trading, and he's like, I get 1% a day, and that's pretty freaking amazing if it's true. He even had links supposedly to his verified accounts or whatever. But that would be badass but I don't know how to day trade, so this is easy mode. Day traders probably have to sit there and stare at their screens for 8 hours, but I spend like, you know, I can roll all my calls on a Friday, 30 minutes, you know, an hour if I'm making a video and just doing it slow as shit. So to me, this is easy mode, and if you're wondering if it's so profitable and so easy, why don't more people do it? I think options are just scary. So the contracts are times 100, so you can't just sell an option on one share. You have to have 100 shares, and I don't know, maybe it's a little bit complicated. You know, they look at this, they don't know what strike to pick, or, you know, nope. I mean, most people can't even pick the right stock, let alone pick the right date and pick the right strike price. So there's extra layers of complexity here, maybe, that turn people off. Every time I talk to somebody in the sauna about it, they're like, it's too complicated, I wouldn't trust myself to do it. So to me, it only seems fair that people who do more work get paid more. So I don't find it strange at all that this can be profitable. And I talked about it a little bit, but why did I pick the strike? And what I really try to do is pick the strike. So I'll add the premium to the potential call away value, and I try to maximize that. Some people go straight to the 0.3 delta. Delta means the value that this option price changes per dollar of the underlying, and the underlying is the ticker. So the underlying price would be 22.45. So if Mara moves up to 23.45, it goes up $1. Then the price of this call will move 0.38. Will go up 38 cents, whereas the price of the stock went up $1. So these don't change in a 1-for-1 ratio. It all depends on this delta. But let's just say if we were trying to figure out, did we want to do this one at the money? So we could get a metric ass ton of premium here. That's like 6%, 1, 2, 3, 4, 5, 7% premium here. Okay, you could take the guaranteed premium, but if Mara goes up above, it goes up even a nickel, you're not going to gain any more value from this. So you're capping your max profit here at 7%. Now, if you go way up here and just try to get like 1%, you go all the way to the 28, you can get 1% guaranteed here, and you're going to get from 22.45 to 28, so that's like $5.50, which is, holy crap, 10%, 20, like 30%, something like that, 20, 30%. Just doing ballparking the math here. And so that's like, a ton of potential, but not a lot of guaranteed. So I generally kind of go somewhere in the middle. So what is this, 28? And at the money is 22. So 24.50 is kind of like halfway between maximum call away value and maximum premium. And, there's about 10% call away value. There's, what did I say this was? 4%. Yeah, 3.5% premium. So guaranteed to get 3%, but have the potential to get 13% for the week. So that's how I select my strike. Now, I don't do technical analysis, and I really don't even do a whole lot of fundamentals. I've basically decided that Bitcoin, MicroStrategy, the mining stocks, and then I also dip my toe in Tesla as well. It's the only other stock outside of the Bitcoin arena that I've done any research in and have any faith in. So I don't waste my time doing a whole bunch of fundamentals trying to look for something else. If my assumptions change about Bitcoin or Tesla, then I would go looking for something else to invest in. But until that happens, I really don't see the point or see the necessity. I'm doing fine just with these few tickers. The other thing about not having 25 stocks in your portfolio is just so much easier to keep track of everything. So, what do I have? 5 or 6 tickers, and is the entire portfolio. And I know the diversify crowd will be calling me dirty names or whatever, but to me, diversification is nothing more than a lack of conviction. So I laugh right back at them. Um, all right, I think that's everything that I wanted to cover. And all right, we'll leave it there. Be good, y'all.